The other day, I saw an eye-catching headline in the Wall Street Journal. Index funds are the new titans of Wall Street. Are they really? Well, many financial coaches teach index funds investing as a passive investing revolution in the stock market. If you ask me, I believe that everything has a front and a back, pros and cons. Hi, I'm Millen, Livis, Holistic Financial Independence Mentor, and today I'm going to start a series of 4 short mini trainings to cover the good and not so good of the investing in the stock market using index funds strategy. Join me to watch this mini training series if you want to be an informed investor in the stock market. So, first of all, investing in index funds is considered to be passive investing as opposed to investing in stocks, which is active investing. But let's start with defining what index funds are. Index funds are mutual funds that contain a basket of stocks or securities that track the components of an existing financial market index. For example, there are index funds that track the Standard & Poor's 500 index, referred to as S&P 500, because it tracks the price performance of top 500 US companies. Since index funds structured as mutual funds, financial instruments, they trade as mutual funds, not like stocks and ETFs, exchange traded funds. Although investors cannot buy an index per se, they can invest in ETFs and index funds that are designed to mirror the underlying market index. In other words, an index fund that tracks the S&P 500 index would have all 500 stocks from the S&P 500 index in its fund. Therefore, index funds tend to provide investors with fairly broad market exposure, relatively low operating expenses, and usually low portfolio turnover, which helps decrease taxes on capital gains. So basically, an average index fund investor is buying all of the S&P 500 companies or other market indices at a lower cost. So far so good, right? Now, for beginner investors, for hands-off long-term investors, and for those who, unlike myself, don't want to spend much time managing their investment portfolio, index funds offer a relatively low-risk way to gain exposure to a wide range of equities. Any investment involves risk, so that's why I emphasize that any investing, particularly we're talking about index fund investing, involves relatively low risk. People who have retirement accounts are likely to invest in index funds because they are considered to be ideal holdings for tax-deferred retirement accounts like individual retirement accounts, IRAs, and 401k accounts. I've been asked whether index funds only investors can lose everything. And frankly, I don't think so, because this would entail that all stocks in the underlying index effectively go to zero, which is highly unlikely. As a matter of fact, the total book value of all underlying stocks in any index fund is expected to increase over the long period of time. And that's why it's considered to be a good investment for retirement accounts. So here again, the 4 main reasons to use index funds investing strategy to invest in the stock market. Number 1, index funds offer broad exposure to stock markets since they track particular market indices. In other words, index fund investors are effectively buying shares in all of the underlying market index companies, like, for example, S&P 500 index companies. Number 2, index funds investors pay a lower price than they would pay for actively managed mutual funds that contain the same stocks. Number 3, index funds investing is considered to be a passive way of investing in the stock market, and they are suitable holdings for tax-deferred retirement accounts, such as individual retirement accounts, IRA, and 401k accounts. And number 4, since index funds have inherent diversification aspect built in, index funds investors will not lose everything, even during the time of market corrections as we experience right now. That's all I have for part 1. Post in the comments if you have any questions, if you have any comments, if you are an index fund investor, would be great to know. And join me next week for part 2, where I will talk about 5 reasons to avoid index funds. Until next time, stay blessed, stay in your power, to your health, wealth, and freedom.